Are you trying to buy a home but you don't have a big down payment? You've probably come across USDA loans and down payment assistance programs, but which one actually saves you more money? In this video, I'll break down how USDA loans compare to down payment assistance programs in terms of cost, qualifications, and long-term savings, so you can make the smartest financial decision for your situation. First, let's do a quick overview of each option. The USDA loan has a 0% down payment. It's available in eligible areas, which are typically rural and suburban. Income limits apply. Usually you can't make more than 115% of the area median income. The home must be your primary residence. There are two types of USDA loans: the guaranteed loan, which is probably the more common one, and the direct loan, which is funded directly through the USDA Rural Development Office. The direct loan is typically for low and very low income earners. To qualify for the USDA direct loan, your income usually needs to be no more than 80% of the area median income. When we talk about down payment assistance, we're really talking about a broad category of programs that work alongside loans, like FHA, conventional, and sometimes USDA or VA loans. These programs can come in the form of a grant, a second loan, or a forgivable loan. Some of them offer money you never have to pay back, while others are repayable either monthly or when you sell or refinance the home. So it's important to read the fine print and understand what you're signing up for. Down payment assistance programs are typically offered by states, counties, or nonprofit agencies, and they may come with repayment requirements or restrictions depending on the source. Let's compare the upfront costs of both options. With USDA loans, like I mentioned before, there's a 0% down payment, so that means in theory it has the lowest upfront cost. With the USDA guaranteed loan, there's an upfront guarantee fee of 1% of the purchase price, which can be rolled into the loan. So for example, on a $300,000 purchase, the guarantee fee would be $3,000. You can either pay that at closing or roll it into the loan. If you'd like free resources like a quick start homebuyer guide or a home buying course, you can go to my website at workwithdang.com. I can help you find a real estate agent in your area. There's more information on my website. I make content like this every week. Please subscribe if you haven't already. USDA loans often result in lower out-of-pocket costs than most down payment assistance programs. That said, down payment assistance can help, but it doesn't always cover everything. If you want to put down more than what the program offers, you'll need to bring in the rest yourself. For example, if you're getting 5% in down payment assistance but want to put down 7% total, you'll need to come up with the remaining 2% on your own. Some programs may cover the entire down payment, but those are probably less common. Now, with down payment assistance, you may have extra fees or higher interest rates. If it's a second loan, you could have a monthly repayment. That means you'd be paying your regular mortgage, and then you'd also have a second loan payment. So essentially, you're carrying two loans. For example, if you receive $10,000 in assistance as a second loan with 1% interest rate, you might end up paying an additional $50 to $100 per month depending on the loan terms. Let's break down the monthly payment comparison. With USDA loans, you typically get a lower interest rate than with a conventional loan, and it might be slightly lower than an FHA loan as well. USDA loans include mortgage insurance, which in this case is called the guarantee fee. There's an upfront portion, like I mentioned earlier, and there's a monthly fee as well. The ongoing monthly guarantee fee is 0.35% annually, broken down into monthly payments. Total monthly payments tend to be lower with USDA than if you're using down payment assistance with an FHA loan, mostly because of the mortgage insurance. FHA mortgage insurance is usually 0.55% compared to USDA's 0.35%. Mortgage insurance is a fee that you pay to protect the lender in case you default on the loan. For conventional loans, mortgage insurance can range from about 0.46% to 1.50% depending on your credit score. For example, if you have a 700 credit score, your mortgage insurance might be around 0.79%. And again, with down payment assistance, if it comes in the form of a second loan, you could have a monthly repayment on top of your mortgage. Plus, sometimes your lender raises the interest rate a bit to offer down payment assistance, so your monthly payment might be higher for that reason too. And just to be clear, it's when the lender directly is offering you down payment assistance and not you going through some sort of program. So overall, USDA usually wins when it comes to monthly affordability, unless the buyer qualifies for strong down payment assistance paired with a conventional loan and has a higher credit score, which helps reduce PMI. Let's talk about long-term costs. USDA loans don't require repayment of assistance. There's no second loan. That's a big plus. However, I do want to mention that if you get a USDA direct loan, you may receive a subsidy, and that subsidy might need to be repaid when you sell the home, usually out of your profits. With down payment assistance, some programs require repayment if you sell or refinance early. You might also be charged interest on the assistance portion, maybe only 1 or 2%, but over time that adds up, and having a second second lien reduces your long-term equity. It's important to understand that with a USDA loan, you start off with zero equity because you're not putting any money down. That's not necessarily bad, but it's good to understand how equity works. Equity is the difference between what your home is worth and what you still owe on it. So if your home is worth $300,000 and you owe $285,000, you have $15,000 in equity. USDA loans tend to save more money over the long run unless you're using a down payment assistance program that's fully forgivable and you stay in the home long enough to meet the forgiveness timeline, or if you're getting a grant that doesn't need to be repaid at all. Now let's talk about eligibility requirements. With USDA, like I mentioned before, the home has to be in a USDA eligible area. Your income must be under the area limits. You have to use an approved lender for the guaranteed loan. For the direct loan, you go through your local USDA Rural Development Office. There's no cash reserve requirement. I think USDA works well for steady W-2 income households. With down payment assistance, eligibility varies a lot. There are thousands of programs out there, and the requirements for credit score, income, or occupation all vary. Some are very specific. You might need to be a nurse, teacher, or a veteran, while others are more general. Many programs are capped at the local median income, but not all. Some require you to be a first-time homebuyer. Most of them require homebuyer education courses. They're usually more flexible on location than USDA. So which is better for you? USDA might be the better option if you're buying in a USDA eligible area, you have steady income but not a lot of savings, you want a lower monthly payment, and you meet the income cap and qualify easily. Down payment assistance might be better if you don't want to be restricted to a USDA eligible area. If you don't qualify for USDA due to income or location, you're using an FHA loan and need help with 3.5% down, or you qualify for a forgivable grant, especially if you're a teacher, veteran, or something similar. USDA loans typically offer the lowest upfront and monthly costs, but they're limited by income and location. Down payment assistance programs can also be a great option, especially if you qualify for a grant and want to buy in a non-USDA area. To learn more about USDA loans, check out this video. Please like, comment, and subscribe.